So we're going to jump into history repeating itself and basically combating inflation with real estate, which is kind of a great topic for what's happening in today's market. And I actually came across this article in the Realtor magazine that came to me in the month of January. And I had bookmarked it that I wanted to talk about this. And then it just so happens that it is on the forefront of everybody's mind today. So according to Lawrence Yen and the chief economist from NAR, is the National Association of Realtors, it says investors may look to the past to find that real estate is a good hedge against inflation. So exactly what we were talking about just a few moments ago. And then here's this chart talking about home prices compared to consumer pricing and how home prices continue to rise. And as we saw last year, and what Chrissy and Tyler both have mentioned, is that the home prices are going through the roof and increasing about 12%. Granted, this is through 2021 and inflation is like 7%, I think is what I read just today. So this is a little bit behind that, but home prices are still going up. And we'll talk about how rents play into that as well. So learning from history, in the 70s, consumer prices increased by 7.1%. Home prices went up by 9.9%. So interest rates were raised. Consumer prices in the 80s went up by another 5.6%. And home prices were 5.5%. And I also read, and I know Ron has talked about this, that the prime rate was through the roof during this time as well. So not what we're seeing today in terms of the interest rate, even with the minor increase that we saw come through today. And the home prices continued, or home sales continued, and rents continued to increase, similar to what we see today. And I will talk about that more in just a minute. From the 90s on, home price growth has matched or slightly outperformed inflation, which again is why it's a good idea to put your money into real estate. And if you recall, we talked previously in January about using your 401k as an option. And so if you actually have questions on that, reach out to us. Chrissy and Tyler definitely can help with that. So rents are accelerating. Rents have accelerated over the last 12 months by a gain of about 5%. And this is a national average. I'll tell you, in working with the leasing team, rents are going up astounding. We are being able to be aggressive, 10% or more on properties that are below the market. And because of competition, it's still a good deal, if you will, for the renters in the properties. So we did some numbers, and I believe we had something like 3%, something, Ron, I can't remember the exact number, but it was really, really small, the number of renters that moved because we increased the rent. So increasing the rent is not, being afraid of a vacancy is not a reason to not increase the rent. Their analysts are saying, and part of this article I was reading, and is what we are also seeing, rents are going to continue to go upward year over year. Main reason, there is a housing shortage nationwide. Renters, people not buying real estate, people staying in place, those kinds of things. There's all kinds of things going on, but there is a housing shortage. So rents are going to continue to go up. The only thing that will cap that is a cap. And we do see that in certain areas in Southern California, LA being one of them. Tyler and I were on a meeting with our attorney, and he's like, first question out of his mouth was, do you manage in LA County? We said no. He said, okay, we can continue this conversation, because LA County marches to its own beat and has a lot more restrictions, including rent caps. There is a movement in the state of California to cap rents all the way around. So we're taking the position that if you can raise rents right now, we should be, because there may come a time in the very near future where they will govern the amount of increase that we can do. And data going along with that is showing that rental vacancies are at a 40-year low. In 2009, the vacancy rate nationally was 11%. In 2021, it was about 56%. I'm sorry, 5.6%. And I can tell you that our management one's rate is about 1%. I know I've mentioned this before. I've been with the company a long time. I have never, in the history of working for Management One, never had properties for rent. And there have been moments in 2021 where we had no properties because people aren't moving. Working from home, working remote has brought about a different hurdle in property management because people can work from home. They don't need to relocate for their jobs, or they can relocate for their jobs because they can go live somewhere else. So you kind of have this tug of war with vacancies, and we certainly have seen that for us. So what is in it for you as an investor, whether you currently have properties or you're looking for a property? This is a great time to grow your wealth through real estate. We've talked about, even though the prices are on the rise, interest rates are low in comparison. When I created this slide, we hadn't had the vote. And of course, we know that the interest rate went up a little bit. I did read that they're projected to raise it 7 times between 2022 and 2023. Small increments, 7 times over the next 18 to 24 months. It's still low compared to the 80s when it was 18%. So if you can, now's the time to call Christia or Tyler. We just mentioned this, but we can't tell landlords enough. Now's the time to increase rental properties, rents on your rental property, because again, they will pass legislation at some point in time. If history repeats itself, Orange County and Riverside County will end up with rent caps. We don't have a magic crystal ball to tell us it'll be next year or 5 years from now, but it's going to follow suit. They will make affordable housing a thing. And you can bet that in the short future, rents will be capped. So you might as well take this opportunity to start bringing your properties up to par in terms of that. We just ran comps on some properties, Ron, and he's like, Kristen, these are so low. Yeah, there's some of our properties that are still renting for $1,200 and $1,300. At today's value, they could be pushing close to $2,000. That's a huge loss, $800 a month times 12 months. That's a huge loss at the end of the year. And let me just say this, you're not greedy to increase the rent. You have to think about rental as a business, and you have to make that mind shift. You're not just a landlord, you are running a business. The government allows you to take those tax deductions because they consider it a business. So you should have that mindset as well. Because here's the thing, right? Who had to go buy a dishwasher lately, or garbage disposal, or any appliance? They're expensive, way more expensive than they were 6 months ago or 12 months ago. That comes out of your bottom line. So by increasing your rent according to market value allows you to recoup some of those costs. And gas alone is up 56%. I drive a minivan and it was very expensive to fill it up, and I don't have a truck. So, you know, it's there. The pain is there. I will answer that question in just a second here. Repair costs are going up, as I just mentioned. Property taxes are increasing. And you know what? Your property is going to need a new roof. If you've had it for 10 years or more, that roof's going to be coming, especially if you bought the house and it was already aged. You're going to have a vacancy. You'll need paint. You'll need carpet. All of these things are going to come. And then you're going to wonder, how am I going to pay for these things? If you incrementally increase according to the law, then you will have money in your piggy bank, as Ron calls it, for those repairs when the time comes. I think this is going to answer your question here. So Current laws in California allow the following, and Tyler and I just like 2 weeks ago met with our attorney to make sure that we were on track with this. So if your property is owned under a corporation, it can only be increased by 5%, that's your base, plus the local CPI. Right now, and I just confirmed today, right now, the local CPI is 3.6% for Riverside County and Orange County. So that's a total of 8.6% of is what you can increase your rent if you're owned by a corporation. If you own it outright and it's a single family home or a townhome, you are not subject to rent control. So you can increase it by 10% with a 30-day notice. Typically at Management One, we do give a 30-day notice. At least we try to give 45 days notice to a resident that the rent is going to go up. So you can do that by 10%. If you have a duplex or a triplex, you automatically fall under AB 1482, and the max you can increase is 10%. Single family homes can actually be increased more than 10%. So if you have a property that is that $800 under market, we can serve a 90-day notice to the resident and increase your rent to swiftly bring it up to market. You probably cause a vacancy because, you know, $800 is a big hit to somebody who's used to paying $1,200. As I mentioned in previous webinars, a month and a half ago or 2 months ago, we talked about using your 401k. Now is the time to take action. Inflation is here. They anticipate it at minimum to the end of this year. As Ron said, it could go another 3 years or more. Home prices are going to continue to rise. Interest rates are still low. They've already told us effective today, they're going to go up. And rents are on the rise, and they're going to continue to rise. So now, if you can, is a time to take advantage of this storm that we're all in. So that's the end of my presentation. Do we have any questions? Or Ron, do you want to add to?
Well, I think I want to put the emphasis on raising your rent. And all of you know, I own several rental properties myself, and I have for years, and I'm still buying today. But the thing of it is you are going to have to replace roofs. You know, you're talking sometimes 15, 20,000, depending on the size of your property. You've got HVAC, air conditioning, heating units got to be replaced, you know, and then of course, all the carpeting and the painting. And it isn't your responsibility to take your money out of your personal savings away from you and your family to fix your rental property. Your rental property needs to take care of itself. But there's two things that has to happen to do that. Number one, you've got to raise the rents consistently. Okay, now this has been kind of a runaway train here with this COVID-19. Okay, but in just normal markets, we want to raise it, you know, gradually. For an example, you take gasoline, right? If gas goes from $3.50 a gallon to $3.70 a gallon, it's not a big deal. But now that it went from $3.50 to $5.50, okay, or in some parts of California, $7 a gallon in LA, it's like sticker shock, right? It's like, what's going on here? Okay, and you don't want that to happen. But residents, as we've talked before, will move 7 times faster because you do not improve that property or take care of maintenance timely than they will if you raise their rent, you know, gradually. They expect that, but they also expect the service, okay, is on it. So that's number one. Number two, and we've talked about this before, but very important, ladies and gentlemen, you need to open up a separate checking investment account where that rental money goes into that account. Because like on that one, if we raise your rent $300, you get $300 more in your personal checking account. It's just going to be squandered away innocently, but it's still going to be away. So when we call you for a $10,000 roof, it's not going to be there. So tomorrow morning, make sure you open up a checking investment account, you know, and make sure all the money that we send you that you put back in that account. Otherwise, the roofs are coming, you know, the HVACs are coming. I don't know when, but they're coming. How do I know that? Because they happen to my properties. Okay. I don't get any special treatment here because I own Management One. I get hit just like the rest of you. So, you know, if there's anything I could plead with the audience tonight is to do those two things. If you do, yeah, you're going to be a happy camper. Okay. So
I would say another thing too, before we move forward is, like Kristen said, that fear of, well, if I raise my rent with my current resident, then they're going to move out and then I'm going to have a vacancy and I don't want that. Well, in today's market, we're seeing that we sometimes rent properties within 4 hours of putting them on the market. And the rents are even more so than they would be to the current renter.
Mm-hmm.
So that's another thing to consider. A lot of times I get, well, I haven't raised my rents in 5 years. And especially within these past 24 months, it's astonishing. And then, some people on this call might be doing it as well, but managing your property on your own, which is fine. But then they want to ask about our management costs. And I say, well, if you look at it this way, if your rent is at $1,300 now and the market is at $2,500, if you come to us and we raise your rent to $2,500, our management cost is free.
Mm-hmm.
And now you have the protection, you have the professional. We're raising rents each and every year, depending on the market. So there's a lot of advantages to doing that. And the consensus is basically, don't be scared to raise your rents, whether you manage your property on your own or we do or another company. Just don't be scared to raise those rents.
Right.
Well, the other thing of it is, ladies and gentlemen, when you do a rehab on a property of 10,000, I mean, between federal and state taxes in California, you're getting 40% of that back. Okay, so it's really costing you 60% or 6,000 to rehab your property. Okay, and the other thing of it is, like Tyler, on the management fee to manage your property, if you're managing your own property today, is if your rent's 13, it should be 25. Your management fee is $1,200 a month, because that's money you could be getting. Okay. Yep. And so you just got to look at that as a management company. And most of you out there manage your own properties. 95% of people across the country raise their rents every 5 years, and normally they'll raise it like $50 or $75. Okay. That's known in the industry, because we're in this myth that people stay because they don't raise the rent. And it's absolutely 180 degrees the other way. Okay. And we've proven it in 37 years of management, one in thousands upon thousands of properties. So it isn't like we're a company that started a year ago and giving you this information. What we're sharing with you here tonight, you can take it to the bank. Okay. So
let me just put in very quickly the resale value. Okay.
Mm-hmm.
Let's talk about that, because I have quite a few properties that we have sold where the owners will express that they want to sell those properties as is for an investor to take over. Going in and, oh, look, we have a guest. Going in and, putting that rehab is an opportunity. It's an opportunity to bring your property up to date, to look at anything that will cost you a lot more money, like termites, roof, things along those lines along the way. In addition to that, we get a much higher rental rate for a property that has been fixed up than for a property that hasn't. But when I resell these houses that are actually move-in ready, that feel good, that look pretty, those are the houses that we're selling at $50,000 above asking. The ones that we're selling as is, we're selling to investors. And most of you are getting flyers from investors saying, I will buy your property cash now, no need to use a realtor. But they're offering you 80 cents to the dollar. In this market, you shouldn't have to take a cut of 80 cents to the dollar. Mm-hmm. By investing those $25,000, say, on a real nice rehab with stainless steel appliances, brand new kitchen, all the perks, you're actually going to get that back. So in more ways than one, in the rental and in the resale value. That is, if you want to capture top dollar with the first-time home buyer, owner-occupied buyer that's actually looking. And if you don't want to do that, then yes, but investors, it's a business. So it's about numbers and making them pencil out. As an agent, if I'm going to represent you, I'm going to say, hey, if you want to put it on the market and get top dollar, I suggest that we fix it so that you have all the options, right? And that you're able to capitalize on what you put into your house. So, yeah.
So, Chrissy, on that, let's just so I understand it. So basically, if somebody invests $25,000, okay, you can get them $50,000 more in price. So not only do they get their 25 back, but they made another 25,000.
Not only that, those houses that we are rehabbing, like the last 4 that I put in escrow, we did full rehabs on those. They sold within 3 days. Where we have neighborhood houses, in this market, nothing's really staying, so I'm not going to use that as leverage, but they're sitting on the market 3 months. They're coming, or I'm sorry, 2 weeks, but they're falling out of escrow sometimes. They're having to do repairs through escrow. Now the property's tied up, and every day that your house is sitting there vacant is a day that you're losing of income.
Yeah.
So in this case, it does give us the upper hand to go in the market, sell right away, get top dollar for our clients, and it almost seems like common sense, but really when you look at the numbers, it makes a big difference in the way that it translates to the consumer.